Most people underestimate what $100 can do. It doesn't feel like much, just a dinner out, a pair of sneakers, maybe a few takeout orders you barely remember a week later. But what if that same $100, invested every single month, quietly grew into something much bigger? Not because of luck, but because of a force working behind the scenes every day. The truth is, most people never see it happen, because they quit too early. They start, they get excited for a few months, and when they don't see huge returns right away, they stop. But the ones who stay consistent, they witness something almost magical. And in this video, we're going to pull back the curtain on exactly what happens when you invest just $100 a month, and how that small decision can transform your finances over 10 years, and far beyond. But before we dive into the numbers, there's something you need to understand, because this isn't just about how much you invest, it's about how you do it. And that single difference is what separates people who end up with thousands from those who end up wondering where all their money went. See, most beginners believe investing is about picking the right stock or catching the next big trend. They scroll through finance TikToks. They see people bragging about 300% gains, and they think, if I just find that one winning stock, I'll be set. But here's the truth. Wealth isn't built through excitement. It's built through repetition. It's built through that $100 a month you invest, even when the market's down, even when everyone else is panicking. Because every time you invest consistently, you're taking advantage of something that the richest people on earth use to their advantage: compounding. Now, I know you've probably heard that word before, but few people actually understand what it means in real life. So let's break it down using a story. Imagine you plant a single seed. After a year, it grows into a small tree that bears one fruit. You eat the fruit, and inside there's another seed. You plant that too. The next year, you have two trees, both bearing fruit, each one giving you more seeds to plant. And over time, those seeds create more trees, which create more fruit, and more seeds again. That's what compounding does with your money. Every dollar you invest starts generating its own seeds, the returns. And if you leave them to grow, those returns begin to earn returns of their own. And here's where things get wild. At first, it's slow, painfully slow. But somewhere around the halfway mark, something changes. The curve turns upward. Growth that once took years now happens in months. And that's when people start to say things like, "How did you get so lucky?" When in reality, it wasn't luck. It was time. So let's put some real numbers behind this. If you invest just $100 every month and your money grows at an average return of 8% per year, which, by the way, is roughly the long-term average of the stock market, after 10 years, you'd have around $18,000. Now, that might not sound like much, but remember, you only invested $12,000 of your own money. The rest, about $6,000, came from your money making more money. And if you kept going for another 10 years, that $100 a month habit turns into over $58,000. Keep it up for 30 years, and it crosses $149,000. And that's without increasing your monthly amount. Just imagine what happens if you slowly raise it as your income grows. $150 a month, $200 a month, maybe $300. Suddenly, you're not just saving, you're building wealth. But here's what most people miss. It's not the returns that make the biggest difference. It's your consistency. Missing just a few years, especially in the beginning, can cost you tens of thousands later. Now, here's where most investors go wrong. They start, but then they watch the market every day. They see red numbers and panic, or they see green numbers and start chasing trends. And before they know it, they've turned what should be a calm, automated process into emotional chaos. The truth, the less you touch it, the better your results will be. Because when you invest the same amount every month, no matter what the market's doing, you're practicing something called dollar cost averaging. It's just a fancy way of saying you buy more when prices are low and less when prices are high. Over time, that balances out your costs and smooths out your returns. And here's the funny part. It's the complete opposite of what most beginners do. They try to time the market, buying when everyone else is optimistic and selling when everyone else is afraid. But the investors who win long term, they do it the boring way, the consistent way, the way that doesn't rely on predictions. Oh, and they also like and subscribe to this channel. Now, let's talk about something even more powerful, what you actually invest that $100 into, because this part decides whether your money grows steadily or disappears into sudden market ups and downs. So, what should you actually invest that $100 in each month? This is where most beginners get stuck. They overthink it or read too many opinions online, and by the time they finally feel ready, months, even years have passed, and they've missed all that valuable compounding time. The truth is, the best place to start isn't a single flashy stock. It's a broad, low-cost ETF, which stands for Exchange Traded Fund. Think of an ETF like a basket filled with hundreds of different companies. When you invest in one, you're buying a little piece of all of them. So instead of betting on just one company like Tesla or Apple, your money gets spread across the entire market. If one company has a bad year, the others balance it out. It's simple, stable, and built for long-term growth. And one of the most popular ETFs is an S&P 500 ETF. It tracks 500 of the largest, most reliable US companies. The same companies that have survived wars, recessions, crashes, pandemics, and everything in between. Over decades, that index has averaged about a 7 to 10% annual return. Not every year, of course. Some years are brutal. But over the long run, it's been a compounding machine. Let's make that real for a second. If you had invested $100 a month into an S&P 500 ETF over the last 30 years, you'd have roughly $180,000 today, and you'd have only contributed $36,000 of your own money. That's not magic. That's time and patience doing the work for you. And that's the key idea I want to make clear. When you invest $100 a month, you're not buying stocks, you're buying time. Every contribution is another brick in your financial foundation, and those bricks keep stacking year after year, while most people are still waiting for the right moment to start. Now, if there's one thing that separates the investors who actually stick with it for 10 years from those who quit after 3, it's this. They automate it. They don't rely on willpower. They don't sit there every month thinking, should I invest now or maybe wait until next week? They set up an automatic transfer that invests for them the same day, every month, and then they just forget about it. Because automation removes emotion. You don't get tempted to pause when the market drops. You don't get overconfident when it rises. You just stay consistent. And that consistency compounds far faster than you think. Remember, investing is not about timing the market. It's about time in the market. Even professional investors struggle to predict short-term movements. But when you zoom out to 10, 20, or 30 years, the picture becomes shockingly clear. The people who stayed invested, who kept adding to their portfolios, and who trusted the process, they're the ones who ended up free. And that freedom doesn't just mean money. It means options, choices, and breathing room. But let's be honest, it's not always easy. There will be moments when your investments drop 10, 20, maybe even 30%, and you'll feel the urge to stop, to wait until things feel safe again. That's where most people lose. Because when you sell or stop investing in fear, you're not avoiding risk. You're locking in losses. But when you stay calm, keep contributing, and let those lower prices work for you, you're actually buying more shares at a discount. And when the market recovers, as it always has, your returns multiply even faster. Think of it like planting seeds in bad weather. It doesn't look rewarding in the moment, but when the sun comes back out, your garden explodes with growth. That's the mindset that turns an ordinary $100 a month habit into something extraordinary. The best investors aren't the smartest. They're the most patient. Let's fast forward 10 years from now. You open your investing app, maybe the same one you use today, and you see your balance, $18,000, maybe $22,000, maybe even more depending on the market. And you realize something. It's not just the number that matters, it's the habit you built. Because that $100 a month, it's not just money you invested. It's proof that you stayed consistent, that you didn't wait for the perfect time, that you didn't panic when things looked bad. You built something invisible, a new identity. You became the kind of person who invests automatically, who lets time do the heavy lifting. And that identity, that's what changes your future. Because after 10 years, you won't just have $18,000. You'll have momentum. You'll understand the game. And you'll realize that what you did with $100 a month, you can now do with $500 or even $1,000 without it feeling hard. That's when compounding truly explodes. And it's how small investors become financially independent, one boring, consistent month at a time. So if you're sitting there thinking, it's only $100, that can't change much, remember this. It's not about the amount, it's about the direction. A decade from now, you'll either look back on this moment as the time you started or the time you waited again. And the difference between those two choices could be hundreds of thousands of dollars. So set it up, automate it, and let time work for you instead of against you. Because in 10 years, when everyone else is still waiting for the perfect moment, you'll already be living the results. And if you're ready to take the next step to see exactly where to invest your $100 for the best growth, I'd recommend you watch the next video on your screen.